This is the Ecommerce Braintrust, a podcast about building momentum online for established consumer brands. Join our hosts and their expert guests for high-level conversations about e-commerce strategies, trends, and innovations. Access our Braintrust and boost your brand's e-commerce potential.
Welcome to the Ecommerce Braintrust podcast. I'm Julie Spear, Head of Retail Marketplace Services at Acadia, alongside Jordan Ripley, my co-host and Director of Retail Operations, also at Acadia. Today, we're joined by Martin Heubel, founder of Consulterce and leading expert on annual vendor negotiations at Amazon. Martin spent nearly 5 years internally at Amazon in various category and vendor management roles prior to founding Consulterce to help brands better understand and navigate their vendor relationships and the negotiation process with Amazon. For today's episode, we're going to be diving into a topic that we love to discuss, and that is the AVN cycle at Amazon. We'll be talking about this upcoming cycle, how it might be different than years prior, and how brands should ultimately be preparing for this process now to ensure they're in the best position for success next year. So with all of that said, welcome to the podcast, Martin. It's great to have you here.
Hi, Julie. Hi, Jordan. Yeah, thanks for having me. Very excited to get into all of these topics today. I think 2024 has so far been a very wild year for a lot of brands with all of the news that we've seen in our industry. It's certainly, again, slightly different as compared to the previous years, also during the pandemic. And I'm sure we're getting to go into all of that detail.
Excellent. Yeah, Martin, I just want to say it's a real thrill to have you on here. I feel like with your content, we're the longtime listener, first-time caller. It's really nice to have you actually on the show. We've been a fan of yours for so many years, and we're excited. So we'll dive into it then. I know time is precious here. We want to get your expert takes on a lot of these matters. So as Julie hinted in the intro, I think one of the traps that brands can find themselves in is a sort of set and forget model at AVN. We've done this process before. We'll follow this. We'll do the exact same spreadsheets that we use for JBPs and AVNs in the years past. And a lot of your content and a lot of your perspective is Amazon is not this monolith that just bakes the same process year on year, and it responds to the environment that it finds itself in, the financial position it finds itself in. So I'm just wondering, for those that have been less in the weeds on this thing, can you walk us through really since like COVID, which sort of reset the industry, how has Amazon approached AVNs over that time? And how is, this year maybe different than those years? Like walk us through that kind of timeline of the last 5 years.
Yeah, very happily. I think a good place to start is always when we kind of have this timeline from probably 2020 up until today in mind, where Amazon was really kind of focused on a lot of growth, almost opening the floodgates towards the shoppers that were shifting from the offline to the online channel during the pandemic, and were really searching for a lot of CPG items, single selling item units that shoppers really wanted to see on the marketplace, right? And Amazon wanted to kind of accommodate for this need and shifting need to cater to those shoppers that came into grocery, food categories, beauty, HPC, or even pet food categories, and wanted to get their items online on the Amazon marketplace as compared to before in store. So Amazon capitalized on this growth focus with a lot of growth and expansion in its retail operating unit, opened a lot of warehouses, invested a lot in capital expenditures. But then when we are also seeing the pandemic kind of ceasing to exist almost towards the end of, or second half at least, of 2022, we're also seeing Amazon shifting back its focus away from a sales an expansion focus towards a profitability focus, where Amazon wants to improve not only its profit margins, but also more and more its efficiencies. And in light of that, I think whoever is already like working and trading with Amazon for maybe a decade or so, you will know that Amazon always has these two sides of its business. It's almost a little bit like black and white. Either they are focusing a lot on growth or they're focusing a lot on profit margins. And depending on which cycle you are, and they can last sometimes only 1 year, sometimes 3 to 4 years more recently, Amazon puts also a significantly different focus with vendors in their vendor negotiations. And this is, of course, what we've seen now over the last few years. So the pandemic was very much growth and expansion focused. And then from the second half of 2022, we're seeing Amazon all of a sudden prioritizing its own bottom line, where more margin support requests are coming into our virtual inboxes, sent automatically, as well as through AVS brand specialists and vendor managers. But then also when we want to kind of update our cost prices to Amazon in light of rising raw material costs, or when shipping container costs have skyrocketed, well, all of a sudden it's not as easy to get the acceptance from vendor managers for all of these cost price increases. So if you're basically entering a vendor negotiation and you say each year, I want to just increase my margins with the online retailer by 2%, well, this may work in the offline world, and I'm oversimplifying here, I'm aware. But with Amazon, it becomes even harder to pursue such a strategy, simply because they are not that kind of retailer who sets the price and then is willing to kind of ensure that they can capitalize on all of the large customer base that they have accrued over the pandemic. Instead, they are staying very true to their core DNA, which hasn't actually changed. And that really means that they want to be very customer centric. They want to offer the best prices at a fast delivery, shipment speed, as well as with a high convenience factor, because that is the kind of proven formula that has worked under both CEOs, Jeff Bezos, but now also more lately, Andy Jassy, and both know that this is kind of a key ingredient to their success. I think when we are looking forward, because this is what probably most of our audience today will be interested in, how the AVN cycle, so the annual vendor negotiation cycle, where you're going to discuss trade investments as well as your front margin base with Amazon, will unfold, and how it will be different from the last few years. It's that we're going to see a much more balanced focus between sales growth as well as profitability. Whoever has negotiated with Amazon in the past year, they will have seen, okay, Amazon is very much focused on almost only its net PPM or profit margin. But in light of the rising competition of Asian-based rivals such as Shein, Temu, or TikTok Shop, Amazon needs to balance its existing focus on profitability more with also expansion opportunities with manufacturing brands in order to maintain its sales rank, but also its category share in a lot of the categories where exactly those rivals are trying to kind of start to competing more with the online retailer.
Yeah, that makes a lot of sense.
Before we move into the total preparation for 2025 and what the carry-on of themes we expect to see in the 2025 AVNs, I had a conversation, I think it was a couple months ago now, with Claire McBride from Stratably, talking about the report that you co-authored with her that was a deep dive analysis of the 2024 AVNs. Before we look forward to 25, are there key themes from your analysis of the 24 AVNs that you think are important to call out and might inform how brands should consider preparing for the 25 AVNs?
Yeah, I would say there's always plenty of data points to look at. But if you're taking a closer look at the kind of key trends that we are seeing unfold, I think some notable KPIs are around the length of vendor negotiations. You will hear it with most of your clients. I see it also with my client base. A lot of manufacturing brands are very frustrated on how long these negotiations tend to take, right? It's not a negotiation where you just basically meet with your buyer, you maybe have one or two drinks, and then you go to a nice restaurant, and then the negotiation is concluded.
That sounds lovely.
All the way. Right. But in fact, the partnership with Amazon is often more transactionally focused, which means so you have to kind of jump through a lot of hoops, and you need to kind of ensure that you're preparing also your senior leadership teams for a much lengthier negotiation cycle. On average, the completion of an annual vendor negotiation takes between 3 to 4 months. So 3.5 months was the average based on the study that I've conducted together with Stratably in our annual vendor negotiation and vendor survey, where we looked at, okay, what were the key results and what were also the key challenges for brands during these annual vendor negotiations. 72% of brands cited some degree of challenges during the annual vendor negotiation. So it's far from a smooth sailing ride. And we're also seeing that it's not only investments that you may be talking with your vendor manager and with other retailers about that fall into the weight in your customer P&L. So think of front margins, so your cost price, as well as your trade marketing investments, but also increasingly these hidden cost centers that creep up and can really eat into your profitability and profit margin without necessarily accounting for it if you're not having really a fully set up P&L overview. Shortages and chargebacks are two of the kind of key cost centers that brands battle with repeatedly over the years and often also make part of the annual vendor negotiation. And what we found out is that oftentimes up to 2.3% of the total net sales of a brand are really kind of captured in these buckets, in these hidden P&L costs that a lot of brands are not necessarily accounting for proactively. And as a brand, you should really kind of take a look at, okay, are you at least asking for recouping this money? Or if Amazon basically denies you a repayment, how do you actually account for these cost centers? Because that, of course, also means that effectively you would have not as much investment power as you potentially thought you would have in the beginning. And then I think very lastly, the average year-over-year increase in trade investments went up by 69 basis points, so 0.69% year over year, which is significant, especially when we're looking at a time where also the profitability and profit margins of vendors are often at an all-time low, and account managers and their head of e-commerce and VPs of sales want, of course, to also not only drive more volume, but also want to drive effectively higher prices, higher cost prices, and also ensure that the gross margin is growing effectively. And if you double click into this result, then what we are seeing is actually that only 9% of brands that were being asked about their last vendor negotiation in 2024 were able to decrease their trading terms year over year. And the majority had actually seen an increase of between 0 to 0.5%. A lot of dynamics, which I think brands need to be very clear-eyed upon already in the preparation process, but then also more so when they're entering the negotiations, because any investment today and these days really should ideally be governed by an incremental return on investment. And oftentimes, vendor managers are not very good to display that and to also kind of really outline, okay, why should a brand invest into certain terms? And the kind of key recommendation that I always give, or rule of thumb, if you will, is if there's no performance report, there shouldn't be really an investment that a brand makes. And interestingly, of course, a lot of brands are not necessarily confident in this approach. So when you're looking at those brands that were actually able, and we're again only talking about 9% of brands who were able to reduce their trade terms year over year, what was their profile? Well, we found that generally speaking, those brands tended to have a slightly higher trade terms exposure compared to the rest of the sample. And we also saw that those brands typically under-indexed in the overall growth trajectory that they have had with Amazon. And that gives us a couple of indications that you almost need to behave as if you have already reached your investment ceiling, and you're also not as dependent on Amazon in order to increase the likelihood of reducing your investment exposure with Amazon. And that typically is correlated and strongly correlated with getting more diversified and also deploying some kind of defensive selling strategies in order to reduce your dependency on Amazon only, whether this is through a hybrid approach or whether this is through increasing your subscribe and save revenue base, because we know that Amazon adheres to completing those orders, even in a trade dispute. Those are all these strategies that I think brands need to become more aware about and also prepare themselves for during the year before even thinking about these annual trade discussions.
Just a little bit to keep an eye on and keep in mind as you prepare. You mentioned earlier that as you've observed AVNs over the past number of years, it's clear that Amazon kind of swings from a sales growth focus to a profitability focus. And when we're looking forward to 2025, what's informing how you perceive that theme to be going into the 2025 AVNs? Is it you have insider knowledge from being formerly with Amazon? Is it based on kind of the quarterly earnings reports or insights that you're getting from the brands that you're consulting with? What are the variables that kind of help you frame your view of how you predict the AVNs will go for the upcoming year and what the theme will be this year?
I think listening is the key theme here, because listening to what vendor managers say to brands, listening to what Amazon communicates themselves during the annual shareholder letters or also during the quarterly earning reports, and then also joining these calls gives you usually a very good indication and understanding of, okay, in which direction is Amazon headed? We've heard Andy Jassy, as the CEO of Amazon, speaking multiple times this year about the requirement to become more efficient and to drive shipment speed more towards same-day delivery and also next-day delivery. Now, If you're looking at it from afar, then you may think, okay, why is that important? I mean, of course, we all want to kind of drive efficiencies, but why is shipping speed important? And I'll come to that in a second. But if you're looking at the key themes for 2024 as well as 2025, I think it's becoming very clear also when you're following the media headlines that Amazon focuses first on automation and offshoring. And you're seeing that when you're comparing what you're actually owning in terms of the number of processes with Amazon as compared to a couple of years ago, if you're a manufacturing brand. Amazon basically just offshores a lot of these services via self-service tools to you via Vendor Central. It is the kind of raising a new order for new products, which was done previously by vendor managers. I mean, this is not anything that a vendor manager will do for you anymore. This is strongly correlated with point 2. They're also reducing their corporate headcount. We're seeing over and over again that either directly or indirectly, they're reducing their overall full-time headcounts that they're deploying on vendor accounts. And the estimation is that in their retail corporate headcount has actually reduced or has been reduced by around 15% year over year. So a lower number of vendor manager is now managing a similar or even higher number of vendor managers. That means Amazon needs to become more efficient. They automate more. They try to backward integrate more with suppliers, which is relating to the supply chain aspects. And what I think you're also seeing in the industry, which is a very painful topic for a lot of our listeners, is that Amazon has been reducing its inventory coverage quite a bit this year. So they are not holding as much inventory and as much stock as probably during the pandemic or even a year ago. Why? Because again, it drives efficiencies for them because they can free up the space in a lot of warehouses that they are trying to kind of efficiently set up as possible. Now, if we follow up on that point, why is that important? And if you're looking at this shipping speed argument that I've made a little bit earlier, shipping speed remains very critical for Amazon because it really drives a higher basket size. There's a very interesting research article from the consumer intelligence research partners out there, which has uncovered that annual spending at Amazon is strongly correlating with the shipping speed over a 12-month period. So speaking very in plain English, that means that if you are getting a product on the same or next day with Amazon, you tend to spend on average roughly $1,300 per year with Amazon. If it's also already 2-day, then you're only spending $1,100 per year. If you're getting the product on average, so if you're not a Prime member and you're getting the product within a range of 3 to 5 days, you tend to only spend $860 with Amazon per year. So you're seeing really a strong correlation between shipping speed as well as the annual spending of end shoppers, which is a clear signal to Amazon to more invest into shipping speed and fulfillment efficiency, which circles back to our main topic, annual vendor negotiations, in which vendor managers will put enhanced emphasis on the fact that manufacturers and vendors will have to become better partners when it comes to fulfillment reliability, which vendor managers directly measure based on how well you're kind of confirming orders and how high or low also your reliability is from a stock out and availability point of view. But I think those will be the kind of top conversations that we are going to shift towards to when we are also entering 2025. And if you as a manufacturing brand and as a fulfillment provider to Amazon can highlight how you can support these efficiency programs, I think there's a good chance that we are able to also kind of capitalize on the cost savings that will materialize on both ends, but also talking more about how we can create more efficiencies along our joint supply and value chain.
You touched on some interesting things there, Martin, around the key pillars that drive Amazon's focus in a given market, right? And for a while, I think there's a differentiation point was assortment, right, against traditional retail. And it was, as you mentioned, how do we get as many CPG SKUs on the market as possible? And that was their focus. And then it became ship speeds, right? And that's clearly a focus now. I'm curious, you mentioned Temu and Shine and some of these other ones where it's price leads first over ship speed. What I think we're seeing is the focus is not necessarily the same always consistently, particularly when we look at different markets, like mature markets, US, UK, EU, those markets might have some focus versus like a Japan, Australia. So I'm just curious, I know you have a very kind of EU focus with a lot of the vendors that you work with, but do you have a point of view on how this might be different where the vendor is located and which marketplace they're focused on and how that might impact their vendor negotiations?
Yeah, I think there are a lot of commonalities between the US or North America as well as the European Union, because Amazon, of course, also utilizes a lot of the learnings that come from the US in the EU here. Typically, we're seeing a strong correlation from vendor managers on focusing this year on net PPM and the exploitation of logistics programs, which is strongly correlated with the fact that these markets have a lot of brands that have reached economies of scale that Amazon can now go after. Because if you're going into more expansion marketplaces that may be not necessarily as mature from a revenue standpoint, well, there are not as many economies of scale for Amazon to go after. And then you're literally just negotiating about cost prices or trade investments where there's a natural ceiling to that. As soon as you consolidate orders or you ensure that also the manufacturing brand has a benefit by changing their supply chain for you as a retailer, I think then we are starting to talk about very interesting aspects of how can we actually make that a joint win as part of the trade discussion. And although some of our listeners will feel that these discussions never happen with Amazon, they do, but it may relate to the fact that you may not have reached simply the kind of right economies of scale or revenue thresholds where Amazon would see the benefits and also the cost savings from onboarding you towards a full pallet, a full truckload ordering, or any of the other initiatives that they are kind of offering to brands. Now, you mentioned already Japan or Australia. I think we're seeing here that Amazon has, particularly in the Australian market, reached much faster a maturity as compared to what a lot of critics would have associated with that market when Amazon just started a few years ago in Australia. Similar in Japan, I mean, for a lot of brands, especially in CPG categories, Amazon has become quite significant. Not as much maybe as in the US or here in Europe, but still it becomes part of a wider mix of retailers that they're going to prioritize. Also because they need to do it to reach younger target groups. The key focus areas for Amazon in those expansion markets, as they would cluster them, is of course also to govern profitability through net PPM, but there's still more of the model available as compared to before the pandemic that you may be used to as a manufacturing brand here in Europe or in the US. Where vendor managers are willing to go the extra mile, and where also these programs and initiatives such as the Amazon Vendor Service are more like the strategic vendor service a couple of years ago, where you still have highly motivated people who want to kind of not only include and exploit the existing standard operations and standard procedures, but also try to think out of the box, which is and has become, unfortunately, the exception in a lot of the more mature markets that we have talked about.
Yeah, no, that makes sense. And thinking about where it's early October now, just starting Q4, and 2025 may seem like a long time away from now, but it'll creep up faster than we all realize. Thinking through what are the steps that I need to do now to prepare myself as a brand, a lot of the things you mentioned are sort of operational focus, right? Like, how do I start palletizing things that might have been in smaller shipments before? So I'm just curious, how much of those things do I have to have in place already? Or can I just speak to, I'm willing to invest in those? Or what sort of generally should I be preparing now, Q4 2024, to set myself up to a good position in 2025?
Yeah, I think, look, there are two schools of thought when it comes to negotiations. Some vendors really say, okay, we basically just let Amazon make the first move and we react to whatever they propose to us. That's not necessarily the school of thought that I'm a big fan of, because it puts you into this reactive spot where you have to react to Amazon's demands. And Amazon has already created the framework under which you're going to negotiate. So I typically recommend to my clients to become quite prepared, although it's a very busy period, but I would rather kind of push the starting date of the negotiation back for a couple of weeks, but get my teams that have direct and indirect touch points with the Amazon account into one room and really understand, okay, what are the kind of key pain points that exist in my vendor business today? And that means, and this may be a little bit different as compared to how you conduct your joint business plannings and vendor negotiations with other retailers, not only to see these discussions as part of your sales function, but also to get your media, marketing, logistics, and finance teams, or at least POC, so kind of the contact persons that are having some part of responsibility for the Amazon business, into one room and really identify for each and every individual function, okay, what are the opportunities and what are also the budgets? Because you really need to know your numbers, not only when it comes to sales and your profit margins and your EBIT, but also, okay, what is happening and what are the kind of budgets available that can help me potentially to shift investments or to shift sales towards more profitable portfolio segments when I work closely with my media teams on activating different products that are probably more profitable for me as compared to last year or as compared to just activating them because they're falling under a certain brand budget. So it becomes really a proactive exercise. And I think this fractional ownership that a lot of multinational organizations are battling with is something that I personally, if I would be in a head of sales or in a VP of sales position, be the first thing that I would try to tackle by getting everyone into the same room and also by driving concise targets that all and everyone is in the end also aligned upon. And that is typically around sales, profitability, and that ties into then also logistics efficiencies that I bet when you're talking to your operations team as a vendor, you can quickly identify. And from there, you can then really define your positioning and anchoring points early. Now, this is quite key because think of negotiation anchors as kind of the lighthouse of your negotiation. Those are the ones where you basically always refer to once the negotiation has started, and they also then heavily influence the negotiation outcome. A good example of that is if you're, for example, targeting category penetration growth. So you have seen over the last few years, you have maybe maintained or slightly lost market share, and now you want to kind of regain that for your respective market on Amazon in the respective category. Now, if you're positioning this as a key objective to your vendor manager from the get-go as part of the kickoff meeting already, that puts you in a good position to then also tie back any subsequent discussions back to this anchoring. So whenever Amazon is proposing to you a new initiative or a new investment opportunity, you can always tie that back and ask them, okay, so how is that helping us to actually drive our target and come closer to our target to improve our category penetration and to also grow our category share? And if your vendor manager then is not fully aligned with the objective that you have set out in order to kind of unlock additional investments, that puts you in a very proactive, but also in a very powerful position to push back against all of these demands that sometimes vendor managers come across without necessarily giving you any kind of insight into the predictable return on investment. And I think really thinking that through, but also becoming proactive in all of what you're doing during the negotiation is a very powerful, yet fairly simple tactic that can unlock a lot of value for you in the discussion.
There is a lot packed in that brands can do to prepare for successful upcoming negotiations. If you had to choose the top priority that you would suggest for brands as they're considering getting ready for 2025 AVNs, what would you identify as the number one priority that would help set brands up for success as they enter 2025 negotiations?
Yeah, I would split it into three aspects. I think the first one is really understand the reality of trading with Amazon and also the reality of negotiating with Amazon. Too often we think about if Amazon could just not follow in price and they would basically become a price leader. Well, it's just not going to happen, right? I mean, since 3 decades, we have seen how Amazon is exploiting the pricing algorithm in a way that it is going to follow. And we can cross our fingers and hope that is going to change. But will that really increase the likelihood of a successful negotiation outcome? No, it won't. We will still have to face the realities of third-party sellers competing for our buy box. And these classic approaches of a more for more investment with vendor managers rarely works, because if you're putting it down to the very key essence, Amazon is nothing else than a marketplace that simply connects existing demand with existing supply. Think of a Facebook, think of a LinkedIn. Amazon gives you just the framework to upload your content. The only difference is they also kind of store your products and ship them to the end shopper. But on LinkedIn, you also don't complain that you cannot set up a post in a different format than LinkedIn offers you, right? And this is the given rule of the marketplace, so to say. The same principle applies on Amazon. So we have to work with a structure that is given. We can complain about it. That is perfectly fine. But we must be aware that this is not going to kind of change the way that we are going to negotiate with them. Second of all, it's really key to become aware of your targets. What do you really want to achieve? And what are your red lines? Amazon has that defined from the get-go of the negotiation, whereas a lot of brands that I work with often define that on the fly, which means that their leadership team is not fully aligned before the negotiation even comes to an end. And this is very difficult. So my recommendation is bring your leadership teams into one room, get them aligned on what are the escalation points, and when do you escalate a negotiation beyond your vendor manager so that it's very clear whom you're talking to and whom you're bringing in from your own company and organization in order to overcome often the short-term oriented and very short-sighted approach that vendor managers deploy. Because let's not kid ourselves, most vendor managers rotate in and out of the position within 12 months, which means they are not having a true interest in initiating certain discussions that will help you grow profitably long-term. And then lastly, and most of all, be proactive. I can guarantee you that you know your business better than Amazon does. So you also need to set the foundation and the framework under which you are going to negotiate. And once again, these anchoring points and setting out clear expectations that you then tie back to and always refer to when you're proceeding in your negotiations. This is a very powerful approach to kind of then bake that into the reality of trading with Amazon. And of course, sometimes it's a little bit easier. I hope for all of you that the 2025 AVN cycle will be a little bit more skewed towards mutual growth instead of just profitability, as I mentioned earlier in our podcast. But yeah, we are going to have to see. I mean, there's so much happening in the world right now. Priorities can change very quickly.
So I hear the main thing in preparation for 2025 is to pursue clarity. Clarity on who Amazon is. They've been very clear on who they are for years. Don't have wishful thinking that they're going to be something different this time. Clarity on your targets, what you want to achieve, and clarity on your expectations of the process. So if you have clarity on those key areas, smoother sailing ahead.
For sure.
Yeah.
I mean, it sounds very simple, right? But make no mistake, I think a lot of us often struggle to even just quantify our arguments that we make in the negotiation. Now, Amazon is a very data-driven retailer, as we all know, right? So these qualitative arguments of, we're losing sales, we are out of stock, well, we need to quantify it. Amazon vendor managers will not put any priority to your demands unless you can back up your claim with a concise number. It doesn't mean that you have to bend to their rules to define what their number is, but you need to kind of come up with a storyline that is data-backed and not just rests on qualitative arguments that you feel, because this feeling that you feel, your vendor manager will not feel. And then all of a sudden it becomes a very subjective discussion, but we want to keep it as objectively as possible. And that typically then also takes a lot of the emotions out that can come into these vendor negotiations and the frustration that is associated with it. Don't despair. Take a look and take your time to prepare the numbers. And as I said earlier, if it means that you have to push the negotiation start out by 1 or 2 weeks because in the heat of the moment in Q4, it's otherwise just not possible, that is perfectly fine. Amazon would do the same, right? And you probably have seen that over the past few years as well. But I think this proactiveness and also the clarity about your numbers and to understand what your leadership team is willing to do and where they are also willing to step in as part of an escalation plan. This becomes really critical. And those brands that are very well prepared and have this clarity, typically also those that achieve the highest success on Amazon in these discussions.
Well, this has been really informative. And I really, really appreciate the insights that you've shared, the suggestions that you're making for vendors as they look forward to 2025 and making AVNs as painless as possible. And as Jordan said, longtime listener, first-time caller here. We're very excited to have had you on for a conversation today and hope to have you on again in the future. Maybe we could do mid-year 2025 check of how did it go?
I would love that. Yes.
Yeah. Did we read the tea leaves correctly?
For sure. That's always a fun exercise to do. And fingers crossed that it unfolds as we said.
Yes, always.
Excellent. Thank you, Martin. This was a true pleasure.
Thank you so much for having me, Jordan and Julie.